recession is on the horizon, because markets are now pricing in 4 to 5 rate cuts for next year. Would that happen in a time of the economy doing really well? Obviously, we're seeing that inflation rates are cooling off dramatically, but I think that's also a sign that the economy is not doing so well, because recessions are always disinflationary.
Hi, and welcome to Wealthion. My name is James Connor, and I'm with Bloor Street Capital, and we have a YouTube channel of the same name. Today, my guest is Ronnie Stoeferle, and Ronnie is the managing partner and also portfolio manager at Incrementum AG, which is an asset manager based in Liechtenstein. In addition to managing money, Ronnie and his team also publish the In Gold We Trust report, which is the Bible for anything and everything to do on gold. Ronnie, thank you very much for joining us today. How are things in Vienna?
Thank you very much, James. Pleasure. I have to correct you, if I may. You said it's the Bible for gold, and I always say, well, gold is not a religion. It's just something that really protects your hard-earned money. It's an important piece of your portfolio, but it's not the solution to all our problems. And I really want to differentiate that, because we want to make a solid case for gold based on your overall portfolio, and not treat it as a religion. So I always have to kind of react when people say it's the Bible of gold. So, sorry for that little comment.
No, I'm glad you brought that up, because a lot of people will see, once we start talking about gold, they're going to think, oh no, another gold bug, and they'll stop watching. But you're not one of these pundits who's calling for a collapse of the US economy or a collapse of the US dollar and hyperinflation. You are simply suggesting that gold is an asset class and it should be part of your overall portfolio mix.
Yes, I think that's important. I mean, we wrote many thousand pages of research about the topic of gold, and gold doesn't work in every environment, but it really works well in times of recessions. That was basically the for the 2023 In Gold We Trust report, where we crunched the numbers in which phase of a recession gold works best. Gold works really well in an environment of a weak dollar. Also works very well as an equity hedge. And it usually works really well in times of deeply negative real interest rates. So that's basically it. And I'm not sure if gold is really an asset. So I'm always a bit hesitant when there's a comparison between gold and equities. I think it's, those are two pillars of a portfolio. I rather would like to compare gold to other fiat currencies. Yeah. And I think it's just the hardest currency, compared to the US dollar, the Japanese yen, the euro, whatever. I think that's really the way that I'm thinking about gold.
I understand. And Ronnie, before we do the deep dive on gold and how it can benefit your portfolio, why don't we spend a little more time on this report In Gold We Trust? And I just want to convey to the audience, it's just not a 10 or 20 page report on gold. It's far more than that. It's full of fundamental analysis, technical analysis. Maybe you can just provide a little more context to this report.
Yeah, well, I started writing this piece called In Gold We Trust in 2007, when I was still a young analyst in a Viennese bank. I didn't have any clue about gold. I just had this mining stock that did tremendously well, and went to my boss and said, well, can I write a little special piece on gold? And he said, go ahead. And that was the first In Gold We Trust report. And now, 17 years later, I'm still writing the report. It's probably the most widely followed publication on gold worldwide. We had 2 million readers last year. Today, actually, we published the Mandarin edition, so it's also available for our Chinese friends. We publish in German, English, and Spanish. And, this is last year's edition called Showdown, more than 400 pages. I've got a fantastic team, 20 people working on this report, more than 20,000 hours of, reading, writing, crunching the numbers, doing the layout. I think it's really important that the report is layouted well. It's we do all our charts on our own. We use quite a lot of side comments from I don't know, from Cicero to Winston Churchill to Homer Simpson. So it should also be to some degree entertaining, because our readers give us their most valuable thing, which is their time. So many people really enjoy and really have a great time reading our reports. And yeah, so I, after so many years, gold still fascinates me. There's every day something new that I learn about gold. I just returned from Dubai, and I have to tell you, talking to Arabic, Asian gold investors and traders gives you a completely different perspective. So I love the topic of gold, but as I've said, it's not a religion, it's not the solution of all our problems. But I think that everybody should at least own some of this, some gold in the current setup that we're in. So yeah, that's basically it, and we're already writing on the 2024 edition of the report. And just one more thing, it is not only one report that we publish once a year, usually end of May. We do have monthly chart books on gold. It's a monthly gold compass, can be downloaded totally for free on our webpage. You don't have to register or anything. We do have special publications where we measure the purchasing power of gold, for example, at the Munich Oktoberfest. So gold measured in beer, but also gold measured in iPhones. And the next one, and we're all really excited about that, because we love going skiing as good Austrians, obviously. We measured the purchasing power of gold in ski tickets. So, the lift tickets are getting more and more expensive. You've got inflation at roughly 7% over here in Europe. But measured in gold, actually, prices are fairly stable. So that's kind of the research that we're doing. It's not only super quantitative and serious. Sometimes it's also really, really fun, and therefore we really enjoy what we do.
No, you're so right about lift tickets. It's amazing how the prices of lift tickets have exploded in recent years. Like, to take my family skiing in the US, like, it cost me a fortune.
Yeah, but perhaps it's just, the weakening purchasing power of the US dollar measured in certain goods. I think that's the way to approach it. And as I've said, measured in gold, prices are actually fairly stable in many different kind of topics. And for example, if it's a standardized product like beer, for example, that's a big difference compared to iPhones, where if you compare the current version of the iPhone to the first edition of the iPhone, I think it came out as $499. Now the most recent one costs, I think, 1,500. But obviously, the the technical stuff, all the cameras, all those services that are nowadays included in a smartphone, that's completely different. Yeah, so actually technology obviously would be deflationary, as we know, but within our monetary system, deflation cannot be accepted. But I think that having this viewpoint of, it's not the prices rising, but rather the purchasing power of the euro, the US dollar, and so on, just constantly falling, I think that gives you a completely different perspective on many things.
Very good points. So let's move on and discuss this report in more detail. The title of this report is The Showdown. What's the significance of that title?
Well, we always try to come up with a leitmotif that basically describes or summarizes the whole report, which is not so easy. But last year, for example, we had the topic of stagflation. Before that, we had the loss of trust, the erosion of trust. We had the monetary climate change, and this year it's the topic of a showdown, and we all know it from the game of poker. It's the final laying down of one's cards face upward, and we said, in markets there are at the moment three different showdowns. It's the showdown in monetary policy, where we all know that the Federal Reserve has basically hit the point where they must choose between fighting inflation and financial stability. So if they continue to be hawkish, if they continue the tight road, probably financial markets, the economy, real estate markets, illiquid markets like private equity and stuff will revolt. And then on the other hand, if they choose financial stability over fighting inflation, they will probably risk losing the credibility that they have rebuilt over the last couple of months. So this is the showdown in monetary policy. The second showdown is the showdown East versus West. So basically the G7 industrialized nations versus the Western world, especially from the viewpoint of gold, where not only central banks but also the private demand is more and more being influenced by emerging markets. So my thesis is that the price of gold is more and more influenced or made actually in Shanghai, in Dubai, and in Mumbai, and to less and less degrees in New York, in London, and in Zurich. So I think we should, in the Western world, we should really focus much more on the structural demand coming from emerging markets, and we all know that the gold affinity, not only in China and India, they are responsible for 50% of global gold consumer demand, but also in countries like Turkey, Vietnam, Saudi Arabia, and so on, is much higher than in the Western world. And the third showdown is actually in the gold price itself, because we know that actually, given the fact that real interest rates have risen so significantly, up 350 basis points in basically 18 months, the price of gold should be significantly lower. So if we would have talked like 1.5, 2 years ago, and you would have told me, we are having like positive real rates now, but it's not the absolute level, but rather the direction and the momentum of this enormous surge of real rates, I would have told you that gold would probably be trading at 1,600. Now we're trading at 2,000, and it's an enormous sign of strength. And therefore, we said that actually, once we hit new all-time highs in US dollar terms, because that's really important. I think that most of the viewers are probably from the US, but over here in Europe, we've seen so many new all-time highs in euro terms. For a Japanese investor, gold is up 25% in Japanese yen terms. That's like the perfect uptrend, from the lower left to the upper right, gold in Japanese yen terms. So we said that once we hit new all-time highs in US dollar terms as well, a new phase of this bull market will actually start. So those are the three showdowns: monetary policy, East versus West, and the showdown in the price of gold.
So let's spend some time on these three different showdowns, beginning with monetary policy. And after much research, you and your team believe that the US is heading into a recession. And I want to just look at the indicators that you're looking at, because when I look at the US economy, I look at GDP growth, the non-farms, jobless rate, the performance of the S&P this year. To me, everything looks pretty good. What indicators are you looking at that tell you the US is heading toward a recession?
Well, I have to admit, we've been wrong with that call. Yeah, we went into the year and we're already pretty concerned regarding an upcoming US recession. And, let's face it, China isn't doing very well. Broad parts of Europe are in a recession, especially Germany. But then when it comes to the US, it's basically the last man standing. But that's also due to this enormous amount of fiscal stimulus. I think that's if we really want to simplify it, that's the main reason why the U.S. is still doing so well. Running an 8% budget deficit in a time of full employment, we've basically never seen something like that. Now, I think the indicators that we follow, for example, is credit growth. It's normally once the momentum of credit growth weakens, that's already a sign that we're moving into a recession. But now we are even seeing negative credit growth. So actually credit is contracting, which is a big warning sign. Then it's obviously the yield curve inversion and the steepening that we've seen recently. It's the leading economic indicator, which is an indicator that we follow very, very closely. It is now down 19 months in a row. So this is always associated with recessions. Maybe it's different this time. I wouldn't bet on it. Yeah. Then other indicators, like more market-based indicators. Have a look at the copper-gold ratio, for example. It clearly shows you that you know, the economy is not doing so well. Have a look at commodities in general. You know, it's doesn't look too bullish to me. So from my point of view, we're clearly late cycle. Obviously, we've got an election year coming up, so the Democrats will try everything to you know, to avoid the R word, and I think they will, with their wording, they will probably become quite creative. And then on the other hand, Republicans will try everything to talk down the U.S. economy. However, I would say that, you know, a recession is not the end of the world, obviously. And I think, you know, the markets are already kind of seeing, and I think that gold is already telling us that gold is that a recession is on the horizon, because, you know, markets are now pricing in 4 to 5 rate cuts for next year. Would that happen in a time of, you know, the economy doing really well? Obviously, we're seeing that inflation rates are cooling off dramatically, but I think that's also a sign that the economy is not doing so well, because recessions are always disinflationary. So therefore, I would say a recession is on the horizon. Perhaps we are already on in a recession, because usually once it's officially announced, the worst is already over. And I think the price of gold, which is usually up 10.6% over the course of recessions. I think the price of gold is kind of confirming that view.
So that's a good overview of monetary policy. I want to move on to the second element of the showdown, which is geopolitics. And you and your team have written a lot about the BRICS and the impact that this will have on the global economy. Maybe you can just expand on that.
Yeah, well, you know, it's this big showdown between the very saturated, perhaps also a little bit arrogant establishment, and the hungry upstarts. So we are seeing that, you know, in 2020 already, the BRICS nations have taken over the G7 nation in terms of share of global GDP measured in purchasing power parity, and now we're seeing 6 new countries joining the BRICS. So it's Argentina, it's Egypt, it's Ethiopia, Saudi Arabia, Iran, and the United Arab Emirates. So I would say there's, from a geopolitical, from a geostrategic point of view, those are very, very important countries. Yeah, they will be responsible for roughly 50% of all global oil exports. So I would say the analogy is a little bit like, you know, 2 brothers, where you know, the smaller brother, the younger brother, is growing up very, very quickly, and you know, he's becoming stronger and stronger, but the big brother doesn't realize it. Yeah, and he doesn't enjoy the fact, you know, that the once little brother is now perhaps even stronger than he is. And I think that it's not only gold, it's obviously also commodities trading in general. It's some sort of critical stance when it comes to the US dollar, when it comes to also US treasuries being, you know, the major reserve for most emerging markets. But I think when it comes to the topic of gold, we're clearly seeing that gold plays a major role for emerging markets, you know, because you know that last year in 2012 we saw the highest amount of central bank purchases in gold ever. So they bought roughly 1,100 tons of gold. And the trigger, obviously, was the decision by the Western countries to freeze the dollar and also the euro reserves of the Russian central bank. And I think this will really go down in monetary history. And since then, we're seeing an enormous amount of gold purchases from the especially the Eastern central banks. I think this is really a main driver these days. So I would say as we're seeing that investors' demand is still quite slow. And for example, we've seen outflows in gold ETFs over the last couple of quarters. So actually, central banks have put in some sort of a floor for the gold price, some sort of central bank put for the price of gold. And those numbers are significant. And for the first 3 quarters this year, they have already bought 800 tons. So actually, I think what was the number compared to the time previous to the Russia-Ukraine war? Central bank purchasing, especially from emerging markets, is 2.6 times higher. So I think that due to the sanctions, where basically the Russians, but also many other countries that are perhaps slightly critical to US policies, they all realize that paper assets can become worthless pretty quickly. So they said, well, we have to diversify into something else. And I think you need something that is neutral, that is traded 24/7, that doesn't have any counterparty risk, that cannot be inflated at will. So gold was the obvious choice, and I think really this central bank buying is a complete game changer for the gold market at the moment.
Ronnie, let's move forward and talk about a possible recession and just operate under the assumption that the US is going into a recession. You and your team have done a lot of research on what assets perform well during a recession. Why don't you take us through your findings?
Yeah, well, we're clearly not in the soft landing camp or in the no landing camp or in the Goldilocks camp. So, what we did in the previous In Gold We Trust reports, we basically said, every recession has 5 distinct phases, and each phase has different characteristics. So we came up with this so-called incrementum recession phase model and crunched the numbers and just researched, what works best in each phase of a recession. So gold on average is a pretty decent recession hedge. So in every recession since the year 1971, on average, gold is up 10.6%, and it is actually up in every phase of the recession. While silver, the S&P 500, and commodities aren't really good recession hedges on averages, they tend to perform much better in later phases of the recession. So this is probably the moment when the Federal Reserve and also politicians really start panicking. That's the point when this whole reflation really sets in. Then you can get a little bit more aggressive. But in the first couple of stages of a recession, you don't want to get too aggressive. What's interesting is that mining stocks actually did on average pretty well over the course of recessions in every recession phase, but in phase 3. So you can read up basically also how we're calculating the model and all the results in our In Gold We Trust 2023 report. But to put it in a nutshell, gold is a really good recession hedge. So if you think we're moving into recession, gold is probably a pretty reliable insurance against that.
So you mentioned earlier that we are seeing record buying from central banks in 2022 and also in 2023. We still haven't seen the final numbers from 2023, but it'll probably be a new all-time record. And that's great, but we're not seeing follow through with the miners. And gold itself is up 10% on the year, give or take. But a lot of the gold producers are underperforming. I think Newmont, the world's largest gold producer, is down 15% on the year. that situation is a little unique because they just did acquire Newcrest, so they're trying to digest that. But Barrick, the second largest gold producer in the world, it's flat on the year. Why do you think we're not seeing much interest in the gold miners? And do you think there's a sense of complacency out there with gold and gold equities?
Well, I would say over the last couple of weeks it changed, and you can see how quickly it actually happens in the mining space, and especially also in the junior space. I can tell you my inbox is full with financings for junior miners, and while let's say in October, companies were not able to finance even at the with really good terms. So it clearly has improved over the last couple of weeks, I would say. But still, it's a tough year out there for the in the mining space, especially in the junior space, but also for the developers. So the main reasons, obviously, cost of capital have risen significantly. Second is the fact that there's very little risk appetite. If you get like 4.5, 5% for fixed income, if you're taking some credit risk, you can get up to 7%. And that's opportunity cost for gold, but also for the gold miners. We all know that the management teams in the mining space could be slightly better. So I think they've lost lots of trust over the previous cycles. They destroyed quite a lot of shareholder value. Then another topic is obviously, political risks. We're seeing it now in Panama with First Quantum, for example. And then I would say, developing and building a new mine, and I have to say I'm on the board of directors of two mining companies in Canada. One of them is Tudor Gold, with one of the largest gold discoveries of the last couple of decades, and the second one is a spin-off of Tudor Gold, Goldstone Metals. And it's just not easy, with all the permits required, with all the legal framework of also, of course, dealing with First Nations and so on. It's complicated, it's costly, and it takes very long. So everything that can go wrong usually goes wrong in the mining space. So it's a tough space. I still like it a lot at current valuations. I think many companies have actually done a really good job over the course of the bear market. So we're very active. We're investing, we're researching, we're talking to management teams. So on average, we meet 120 management teams in the mining space. And I have to tell you, I mean, that's our job, separating, how do you say that, the wheat from the chaff. And there's some tremendous opportunities in the mining space at the moment, and we're really excited.
And given your positive stance on gold as an investment, what percent are you recommending to investors that they allocate toward gold or gold equities?
Well, I would say that, the 1 to 2% that many banks actually advise, that's not enough. From a portfolio point of view, it doesn't make any difference. So I would say it should at least be 8 to 10%, perhaps even more. But that really depends on the age of the investor. It depends on the other asset classes. It depends on your time horizon. It depends on your risk tolerance and so on. But there was a great study coming out from Bank of America, which basically said that 71% of all advisors in the United States have 0 to 1% exposure to gold, and 27% of them have 1 to 5% exposure to gold. So it is definitely not a crowded trade. This is also something that is confirmed by ETF demand. We've seen outflows over the last couple of quarters. So I think it's, even though we are trading at or close to all-time highs, it is still something that is it's kind of climbing this wall of worry, especially from Western financial investors. It's still not something where I would see an enormous amount of bullishness. Also having a look at, the price forecasts from all the major banks, and, the outlooks now coming out. I've been studying, the 2024 outlooks from all the major banks, and gold isn't a big topic. It's basically, everybody's writing about, now is the time to invest in bonds. So that's a pretty good sign from my point of view. So to answer your question, I think there's no perfect number for your gold allocation. It probably depends on your bearishness. It depends on the rest of your portfolio, but it should definitely be significantly more than 1 to 2%, because even if gold would go through the roof and everything else in your portfolio wouldn't do so well, this very, very small allocation wouldn't make a big difference for the portfolio. So I would say between 8 to 15%, something like that.
So let's look at your target prices, both long term and shorter term, as we look out into 2024. Where do you see the price of gold going?
Well, I would say 2,300. That's like the next big target. But of course, once we're above new all-time highs, this is really where the momentum kicks in. This is the point in time when CTAs and more short-term traders will really get into gold. Um, so, as I've said, by any metric, gold is not a crowded trade yet. It can become a crowded trade, but I think, Jimmy, if we've had this major top in August 2020, which was an 8-year cycle top, and since then we've basically seen a very volatile sideways consolidation. And from a technical point of view, those sideways consolidations are basically the best cyclical correction pattern that we know in technical analysis. And I think given the fact that US real interest rates have risen so significantly, gold should have corrected much, much more. So I'm interpreting that as a real sign of strength. And therefore, I think that once we really break out above the old-time highs, then it can go really quickly. So 2,300, that would be the next major top. But our long-term target for the end of this decade is 4,800 US dollars. We've announced that in our 2020 report, based on a very simple monetary model, and you can read everything about that model in the 2020 report. And I still think that $4,800 by the end of this decade is quite realistic. Yeah, actually, there was a technical trader from UBS who put out a really good piece, and he forecasted up to 8,000 US dollars for the price of gold as the target for this new bull market. 8,000, that's pretty optimistic. But as I've said, so far it's not a crowded trade. We don't really see investors' demand from the Western world. We're seeing this very stable and strong demand coming from central banks, which kind of put a floor under the gold price. And therefore, I think it's a really good setup that we're seeing for the next couple of years.
And given that the money supply has doubled in the last 4 years, those are not outrageous target prices by any means.
Exactly. And the big question is obviously, first of all, people calling for $10,000 gold. I'm not sure if I want to live in such a world. It probably would go hand in hand with, let's say quite a volatile environment, to be diplomatic. But then on the other hand, probably, what's the price of a beer gonna be in that environment? Yeah, significantly higher. So my take has always been, gold is not there to make you rich quickly. It is really there to preserve your purchasing power over long periods of time. It's there to, for this kind of big shifts from one monetary system to another monetary system. This is really the time when you want to own gold. Now, for US investors, that might sound a bit strange, but if you talk to my grandparents, for example, they had 4 currency reforms. Yeah. And if they wouldn't have owned any gold, they would basically have lost everything through every currency reform. So therefore, I think this is the reason why you want to own gold, protecting your purchasing power over long time frames. And I think that gold did its job really, really well over the last couple of years, over the last couple of decades, and actually over the last couple of centuries.
Very interesting points, Ronnie. And I just want to summarize your whole thesis so to make sure I have it correct. But you're saying that the US is going into recession. You think the Fed is going to panic because of that, and they're going to cut rates, especially going into an election year. And that's going to result in a lower US dollar, and that's going to propel gold higher.
Yes, yeah, that's sounds about right.
And then, of course, if you add in geopolitical risks, that can also accelerate the move in gold.
Yes, but then I think people overestimate the political or geopolitical impact on the gold price. Yeah, I think we crunch the numbers, and such geopolitical events most of the time only really have short-term consequences for the price of gold. Of course, wars are inflationary. Wars mean more debt, mean lower rates usually. But I think just panic buying gold because there's a new war and new conflict. That's not the right motivation actually. Um, but I think that what's really important is to say that we're seeing this let's say the love trade. I don't know who came up with that term. I think it was Frank Holmes who said that there's the fear trade, and this is basically the reason why so many people on the internet try to recommend gold. But there's also the love trade, and this is really the fundamental physical demand for gold in emerging markets. And as I've said before, if you travel to Dubai, if you travel to Vietnam, to China, of course, to India, you can really see how important gold is for the daily lives of those peoples, how important it is for asset allocation. And I've said that a couple of times. The best questions after a keynote that were ever asked, yeah, were in Turkey, because the Turkish lira isn't I would say, one of the strongest currencies. Turkish people are just used to double or triple digits inflation. So for them, you know, gold is not like a satellite investment. It's actually the foundation of their portfolios. It's really a building block for portfolio construction. So one of our main theses is obviously that the great moderation is over, that we're moving into an environment of more inflation volatility, of more macro volatility. And I think, therefore, also in the Western world, gold will become less of a satellite investment, an alternative asset or something like that, but just it will be quite normal for many investors out there to say, well, you should have at least 5, 10, 15% of gold in your portfolio.
Interesting comments, Ronnie. Ronnie, as we wrap up, I can see you have a very extensive library. You must be a voracious reader. Are you reading any interesting books at this time?
Yeah, of course. Yeah, I mean, I got five new books delivered today. My wife, my wife doesn't know because she says, you're ordering too many books. But I'm reading. There's like I always have. When I'm traveling, traveling with 3, 4 books. So for example, there's Die Welt von gestern, Stefan Zweig, The World of Yesterday, also a really good English translation. Beautiful book about the hyperinflation, what it does to society, what it does to politics. Then I've got that's a great book. It's called Same as Ever. Morgan Housel. He wrote The Psychology of Money, which was a tremendous book. For a report that we are writing, I just got my book, Austrian School for Investors, again. And we published that in 2014. Wrote quite a lot about Bitcoin already back then. And it's still a really good read. I hope it doesn't sound arrogant, but I really enjoyed writing this book, and we got tremendous feedback. And then there's another one here. It's called Breath. by James Nestor. I'm doing lots of sports, and I just did a Wim Hof, the Iceman, a seminar over the weekend, with ice swimming, and also breathing techniques. So that was super interesting. So I look forward to reading that book over the next couple of weeks.
Wow. Are you into ice swimming?
I kind of got into it because taking a very very cold shower in the morning. I still hate it. Now I'm able to do it like 3 to 4 minutes. But it's really, the positive effects on, not only your health, but also let's say your mental health, yeah, are tremendous. So I did some ice swimming, and it's not easy, and it's can also be quite dangerous, but it is something that I really enjoy exploring. So therefore I kind of, you know trying to I'm always trying to challenge my borders and get out of the comfort zone. It just, it broadens your perspective and your horizon.
That must also help get your mind off the markets.
Yes. That's if you're plunging into ice cold water for a couple of minutes, you don't think about the S&P 500 or what Mr. Powell is gonna do or say next.
Well, Ronnie, that was a fascinating discussion, and I want to thank you very much for spending time with us today. If someone would like to learn more about you and the services that you and your firm offer, where can they go?
Yes, we're an asset manager, managing 6 investment funds. Most of them, I would say, in the commodity space, gold, silver, mining, but also Bitcoin are topics that we really enjoy investing in, and our performance of our funds was pretty spectacular this year, I have to say. So it's been a good year. So that's incrementum.li, where we also offer wealth management services for high net worth individuals, primarily from German-speaking countries. And then for the In Gold We Trust report, which is the research report that my team and I put out, it's ingoldwetrust.report, available in English, in German, in Spanish, and also in Mandarin. You can download all our publications. So the big report, 400 pages, there's also a compact version, and there's the monthly chart books, there's special chart books, there's special publications. You can download everything 100% free of charge. You don't have to give us your email address or anything. That wouldn't be possible without the support of our premium partners from the industry that basically said, well, actually, we like the stuff that you do. There's not enough sober and honest research in the gold space. So they're supporting us. So we are able to put it out 100% for free. And then I'm also quite active on Twitter. My handle is at Ron Stoeferle, and I'm putting out, charts, but also, stuff about music and some sports, and just trying to also connect with people from all over the globe. And yeah, so that's basically it.
Ronnie, once again, thank you. That was a great discussion. Look forward to the next conversation.
Thank you very much, James. All the best to you and your people watching this. I really enjoyed it, and wish you all the best. Take care.
I hope you enjoyed that discussion with Ronnie Stoeferle, and I want to remind you of another new show that we have on Wealthion called Speak Up with Anthony Scaramucci. Yes, the one and only The Mooch is now on Wealthion, and you can see him live this Friday at 11 a.m. This is your chance to ask the Mooch himself any questions you want on personal finance or the financial markets. Once again, this Friday at 11 a.m. If you are trying to figure out how to prepare for your financial future, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with an advisor. There's no obligation whatsoever to work with any of these advisors. It's simply a free service that Wealthion offers to its viewers. Don't forget to subscribe to our channel, wealthion.com. We have some amazing content coming out in the coming weeks that will help you prepare for your financial future. Once again, thank you for spending time with us today, and we look forward to seeing you again soon.